Direct costs are expenses a company has that are directly related to the activities of a project or a department. Analyzing direct costs is an important activity because it helps managers understand if projects are profitable, if expenses are out of line for one department versus another, and if managing a project directly is more cost-effective than outsourcing it. Being able to analyze the costs of each internal group is important, especially when budget cuts are necessary or searching for ways to trim costs. By looking at each group, management can look for expenses that could be cut, while having the least negative effect on company performance. There are two basic ways that direct costs are used. The first is in calculating the production costs of a product. The cost of goods sold, or COGS, is the amount of all of the supplies used for creating a product, the labor costs from employees working on a product, the space needed to create the product, packaging costs, utilities used in production, and equipment use. All of these expenses are added together to calculate what it costs to create a product. Understanding the cost of a product is vital in creating a sales price that is profitable and ensuring the product is making money, not losing money. The second way that direct costs are used is in calculating the operating expenses of a department or division of a company. Direct costs that a department may incur include payroll for department employees, office or workspace for the members of the team, training expenses, travel and entertainment costs incurred by a department, and any other expenses that are specifically associated with each department. Let's look at a couple of examples to help us understand direct costs better. In the first example, you are a shipping manager for a large business. Your responsibility is to break down the shipping costs to ensure the expenses are charged to the right department. As you begin organizing the shipping costs, you realize you have mail and packages that must be shipped for several company divisions: administrative, accounting, marketing, sales, and operations. As the manager, it is your responsibility to break down the costs further. By posting the cost of shipping to each department, the operating expenses for each division is correctly reported. If the shipping costs were lumped as one amount to one general account, there would be no way to know how much shipping and mailing each department did and what amount of the total shipping expenses they are each responsible for. In our second example, you are a coffee shop owner. You see an opportunity to sell fresh pastries in your shop and want to know if it is a profitable business. It is important to track the cost to make sure you are making money on the pastries. As you create the pastries, you're carefully tracking the items that are purchased for the baked goods. The additional payroll, equipment, and utilities required to prepare the pastries is closely tracked and accounted for as the direct cost of offering baked goods. After the first month, you realize the baked goods are bringing in more money than it costs to prepare them, and you feel the demand will grow as people become more aware of what you're offering. Because your direct costs were so clearly tracked, you were able to make a smart and profitable business decision. To calculate direct costs of a product, every expense that is incurred as a result of creating that product must be included. This includes supplies, equipment use, payroll, office or warehouse space, and any other costs that the company has specifically because it is creating the product. To calculate direct costs of a department, the expenses that apply to operating that department must be included, such as staff salaries and benefits, office space, office supplies, travel and entertainment for the group, and any other costs that are associated with that division's business activities. Direct costs are expenses that are tied to a specific department or project. Direct costs are calculated to ensure projects are profitable and departments are running efficiently, and determining if projects should continue or be repeated, and analyzing whether it is more cost-effective to outsource projects or manage them in-house. Indirect costs are expenses a company may incur that are not associated to a specific product or project within a company. These costs may also be called administrative expenses or overhead costs. Imagine that you are a manager for a small business that provides bottled water to local companies. As you review the monthly invoices, you find many invoices for expenses that have nothing directly to do with water bottling or distribution. However, these are expenses that are important to the operation of your business. For instance, you notice your office supplies are quite high, especially printer paper. As you inquire, you find that the computer software your company uses for accounting uses standard printer paper when generating customer invoices. These invoices are sent to all customers to bill them for water deliveries. While the printer paper isn't directly tied to bottling or distributing water, it is critical to be able to bill companies for their service. The printer paper is an indirect cost to your company. As manager, you can try to cut some of these indirect costs or reduce their impact. In a small business, indirect costs can be more easily identified and managed. However, in larger businesses, it can be very difficult to understand which costs are necessary, if they are legitimate to the operations of the company, and how they contribute to the success of the business. As a result, overhead or indirect costs can become excessive and may be unnecessary. Managing the indirect cost is an important part of a manager's job. Indirect costs may be found in innumerable places within a business's accounting records. However, what may be a direct cost to one company could be considered an indirect cost to a different company. Let's imagine that rather than working for the water supply company, you are in a management position for a stationery and greeting card store. For the stationery store, the purchase of bottled water is not tied to any specific sales or products offered at the store. Because of this, the water used by your employees when they need a drink is an indirect store supply. Other expenses, such as cash register tape, bags to put customer purchases in, and utilities, are similarly considered indirect costs. They are expenses that are needed to keep the store open and facilitate the sale of goods. However, they are not tied directly to the greeting cards and stationery that is available for sale. Indirect costs are expenses a company may incur that are not associated to a specific product or project within a company. These costs may also be called administrative expenses or overhead costs. Such costs can be difficult to manage because they are not tied to revenue-generating activities, nor are they typically tied to products or services offered by a company. As general expenses, they can be lumped together into one category, thus increasing the possibility that non-essential items are purchased or expenses are charged to the company that are not legitimate costs. While managing indirect costs is challenging, it is essential to expense control.
All business costs can be classified as either variable costs or fixed costs. Fixed costs are those costs that do not change based on production levels, while variable costs increase or decrease based on production. Fixed costs can be assets like buildings and equipment. For example, a beverage company that bottles water is going to need a physical building and an assembly line that includes specialized equipment. If we assume the building and equipment are leased, there is a monthly payment for each of them. The company is responsible for paying 100% of the monthly payments, whether they produce 1 case of bottled water or 10,000 cases of bottled water. It is important to note that fixed costs are not always the same. Like the price of anything, they can change. Sometimes unpredictably, and sometimes on a regular schedule. But they do so based on some other factor, not the level of production. For example, if a lease contract is being renegotiated and a $10,000 per month lease payment is increased to $10,500 per month, fixed costs have risen, but not because of production levels. As mentioned above, fixed costs are one part of the total cost formula. The formula used to calculate costs is FC plus VC of Q equals TC, where FC is fixed costs, VC is variable costs, Q is quantity, and TC is total cost. It is important to understand that variable costs, as opposed to fixed costs, are those costs that change based on the amount of product being produced. For example, our bottled water company has a variable cost in bottles. The more bottled water they produce, the higher their cost associated with bottles will be. If we return to our bottled water company and say that the monthly lease for their building is $10,000 and the monthly lease for the equipment is $15,000, then our total fixed costs are $25,000. If the costs of labels, bottles, packaging, and water that go into each case of bottled water is $2, then our variable costs are $2. At this point, we have our cost structure as $25,000 plus $2 of Q equals TC. Now, each month, total costs can be calculated by plugging actual quantity produced into the cost function, which gives us $25,000 plus $2 of $30,000 equals TC. We can then get our total costs, TC, by doing the math. $25,000 plus $2 of $30,000 equals $85,000. With this information, per unit total costs can be calculated by dividing the quantity produced into the total cost. Based on our sample months above, per unit total cost would be $85,000 divided by $30,000 equals $2.833. The implications of fixed costs will become clear when you've learned about overhead costs, variable costs, and the total cost formula. For the purposes of this lesson, the important thing to remember is simply fixed costs are costs that do not change based on production, such as assets like buildings and equipment.
Variable costs are expenses that fluctuate proportionally with the quantity of output. Variable costs are directly tied to the activities of producing volume, which rises when these activities increase and falls when activities decrease. This effect can be related to materials, labor, and sales commissions. For example, if you produce spark plugs, the copper used in production is a variable cost. This means if you stop producing spark plugs, you would no longer have the cost of copper. Additionally, regardless of how many spark plugs you produce, the price of copper for one spark plug remains unchanged. The formula to calculate variable cost is total variable cost equals total quantity of output times variable cost per unit of output. To recognize variable costs, it is important to understand how to categorize costs. Variable costs are those which do not remain constant, specifically when production activities fluctuate. For example, items such as rent, utilities, and executive employee salaries are fixed costs because whether you produce one spark plug or 50,000 spark plugs, these costs will remain constant each month. Materials, production labor, and sales commission costs will fluctuate with the number of spark plugs produced and sold, so they are variable costs. Understanding the classification of your costs is critical to the calculation. Understanding the difference between variable costs and other costs, such as fixed costs, will allow you to better classify your costs correctly. This is known as categorizing costs. Most of the time, many of the costs will be easy to recognize, but in some cases it can be more difficult. For example, a sales rep might be compensated with a fixed salary along with a commission that fluctuates with sales performance. In this scenario, the commission would fall into a variable cost category, whereas the salary is fixed. Total all the variable costs for a specific period after you complete the categorization process. For example, consider our spark plug manufacturing operation that has 3 different variable costs: materials, labor, and sales commissions. Pretend our incurred costs for last year were $50,000 of raw materials, $30,000 of labor, and $10,000 in sales commissions. The total variable costs for last year would be $90,000, $50,000 plus $30,000 plus $10,000. These expenses are specifically tied to the production activities for last year. After determining the variable cost total for last year, we then divide the total variable costs by the production volume. By dividing the total variable costs for a specific period by that same period's production volume will provide us with the variable cost per spark plug. For example, if the spark plug business made 500,000 units last year, its unit variable cost is $90,000 divided by 500,000, or 18 cents. This cost per unit is the variable cost of each variable unit produced, or in other words, the additional cost incurred for the production of each spark plug. For example, if the business produced 1,000 more units, it would expect to incur additional production costs of $180. An important fact to remember is that in many situations, increasing production activity would still make each additional spark plug more profitable. The reason for this relates to the fact that our total fixed costs are now being divided across more spark plug units, making the sale of each spark plug at a better margin. For example, if the spark plug business spends $100,000 per year in rent, rent costs are allocated to each unit at 20 cents per unit. If we are able to increase production by 3 times, rent is now allocated at only 7 cents per unit, creating more profit margin on each spark plug. Variable costs are expenses that fluctuate proportionally with the quantity of output. Variable costs are directly tied to the activities of producing volume, which rises when those activities increase and falls when activities decrease. This effect can be related to materials, labor, and sales commissions. The formula to calculate variable cost is total variable cost equals total quantity of output times variable cost per unit of output. Understanding the classification of your costs is critical to the calculation. Understanding the difference between variable costs and other costs, such as fixed costs, will allow you to better classify costs correctly. This is known as categorizing costs.
As the owner of a car dealership, you employ many different employees. Their responsibilities range from accountants in the finance department to the mechanics that work on the cars. But for the focus of this lesson, it will be the car salesman that takes center stage. You see, with a car salesman, you have to pay them a base salary and commission for each car that they sell. Therefore, a car salesman is a good example of a mixed cost. Why does a car salesman fit the parameters of a mixed cost? Well, a mixed cost is an expense that has both a fixed cost and a variable cost. On the one hand, a variable cost is a cost that changes with production. For our car salesman, the commission is the variable cost because when he sells more cars, he earns more commission. When he sells fewer cars, he earns less commission, and no commission may be paid at all if the salesman sells no cars. On the other hand, a fixed cost is a cost that stays the same no matter the production. These costs cannot be eliminated because they have to be paid no matter what. Take the base salary of the salesman, for example. Even if the car salesman does not sell any cars, the employer must still pay him a base salary. Other examples of fixed costs include rent, insurance, and utilities that have to be paid every month. We now know that when you have both variable and fixed costs, you get a mixed cost. Let's explore a couple of examples of mixed costs in real life to better understand the concept. Let's first look at the other side of car sales, car ownership. When you own a car, you need insurance to drive it. You pay the same amount for insurance every month, no matter how much or how little you drive the car. So, insurance is a fixed cost because it doesn't change and can't be eliminated. Fuel, on the other hand, is a variable cost. The amount you pay for fuel depends on how much you drive your car. The more you drive, the more gas money you spend. As you can see, car ownership involves both a variable and a fixed cost, so it involves mixed costs. Owning a cell phone also involves mixed costs. Each month, James pays a base price for his phone service. This is the fixed cost. He pays the same base price each month no matter what. However, when James uses more data than is included in the base plan, he pays for each gigabyte that he goes over. So the extra data is a variable cost. A mixed cost is one that has both a variable cost and a fixed cost. A variable cost changes with production. The more production, the higher the variable cost. Some examples of a variable cost include commission and fuel usage. A fixed cost, on the other hand, remains unchanged no matter production. An example of a fixed cost includes base salaries and basic monthly cell phone packages. Both have to be paid regardless of production or productivity.
We all know that businesses have expenses. They have to pay for the building in which the business is located, employee salaries, supplies, machines, advertising, and much more. What may be more of a mystery, though, is how those costs get labeled. More specifically, how does management decide what types of costs these expenses fall under? In this lesson, we will look at two types of costs that are greatly influenced by the decisions made by management: relevant and irrelevant costs. Relevant costs are those that are directly tied to a specific management decision. These costs change in the future as a direct cause of that management decision. In other words, relevant costs are those costs that experience some change, whether negative or positive, because of a decision that management makes. Let's imagine you own a doll-making business. Currently, you have 5 employees who sew the dolls together by hand, carefully stitching every detail. As your business continues to grow, you begin to think about the possibility of purchasing sewing machines that would significantly speed up the process of doll making. If you purchase these machines, you would decide to lay off 2 seamstresses, since you will no longer need all 5. 3 seamstresses will be just as productive as 5. The salary that you pay your seamstress would be considered a relevant cost because the expense would be reduced in the future as a direct effect of a management decision, buying the sewing machines. The exact opposite of a relevant cost is an irrelevant cost. Irrelevant costs are those that are not tied to a particular management decision. They do not change as an effect of a given management decision. While one cost may not be affected by a particular decision, it is important to keep in mind that these same costs could be affected by other management decisions. Let's return to our earlier example with your doll-making business. We know that management is thinking about purchasing sewing machines and laying off 2 seamstresses. The salary that management decides to pay the advertising supervisor would be an irrelevant cost, because advertising and the cost of employing the advertising supervisor would not be directly affected by the management decision. However, let's say that the advertising supervisor would be responsible for developing an advertising campaign that tells the public how much more durable machine-made dolls are compared to the hand-sewn dolls. This would require additional pay for the advertising project. In this case, the advertising supervisor's salary would become relevant. That's because the cost of salary would be directly affected by the new sewing machines. Businesses encounter many costs, and so they classify those expenses according to the type and importance. 2 types of costs are relevant and irrelevant costs. Relevant costs are expenses directly affected by a particular management decision, while irrelevant costs are expenses not directly affected by a specific management decision. It is important to remember that, though a cost may be irrelevant for one management decision, it may be relevant for other management decisions.
When economists, production managers, or others refer to average total cost, they are referring to the per unit cost that includes all fixed costs and all variable costs. Knowing average total cost is critical in making pricing decisions, as any price below average total cost will result in a financial loss. Total costs are made up of fixed costs, those costs that are required for production but do not change based on output, and variable costs, those costs that increase or decrease as output increases or decreases. For example, if an organization manufactures desktop computer screens, the glass screens, plastic casings, electrical boards and wires, and screws are all variable costs. The cost of the facility they are made in and the equipment used to assemble the monitors are fixed costs. It doesn't matter if 1 monitor is made or 100. The cost of the facility and equipment will remain fixed. The average total cost is sometimes referred to as the per unit total cost, since it is calculated by taking the total cost of production and dividing that by the number of units produced, quantity. In variable form, it looks like this. TC divided by Q equals ATC, where fixed costs plus variable costs, quantity, equals TC. In the computer monitor example, let's set our fixed costs of the monthly lease payment for the equipment and building at $50,000. We can set our variable costs at $100. For purposes of comparing how average total cost can change based on production, let's set output, Q, at $4,000 in July and $6,000 in August. In July, our total cost is $50,000 plus $100 times $4,000 equals $450,000. Once we have total cost, we can divide that by our quantity produced to get average total cost. For July, $450,000 divided by 4,000 equals $112.50. In July, each monitor produced cost $112.50. Using the same formula for August, but increasing production, results in an average total cost of $108.33. Why did the average total cost go down? While total variable costs increased as production increased, there were more units to share the fixed costs, resulting in a lower average total cost. Perhaps the most common use of average total cost is to identify a break-even price based on a given production level. The break-even price is the price that, if all units sold, would result in no financial loss and no financial gain. In July, the average total cost per computer monitor was $112.50. If the company sold those monitors for $112.50, they would break even. Knowing the break-even price can help inform the pricing decision. Perhaps now that they know the average total cost per monitor is $112.50, management sets the sales price per monitor at $150. In August, the profit margin would increase as the sales price stays the same and the average total cost decreases. Average total cost, sometimes referred to as the per unit total cost, is the per unit cost. This includes fixed costs, those costs that are required for production but do not change based on output, and variable costs, those costs that increase or decrease as output increases or decreases. Any price below average total cost will result in a financial loss. Average total cost is calculated by taking the total cost of production and dividing that by the number of units produced, quantity, which looks like this. TC divided by Q equals ATC. Fixed costs plus variable costs, quantity, equals TC. Average total cost is used to identify a break-even price, the price that, if all units sold, would result in no financial loss and no financial gain. Marginal cost is the increase or decrease in the total cost a business will incur by producing one more unit of a product or serving one more customer. If you plot marginal costs on a graph, you'll usually see a U-shaped curve where costs start high but go down as production increases, but then rise again after some point. For example, in most manufacturing endeavors, the marginal costs of production decreases as the volume of output increases because of economies of scale. Costs are lower because you can take advantage of discounts for bulk purchases of raw materials, make full use of machinery, and engage specialized labor. However, production will reach a point where diseconomies of scale will enter the picture, and marginal costs will begin to rise again. Costs may rise because you have to hire more management, buy more equipment, or because you have tapped out your local source of raw materials, causing you to spend more money to obtain the resources. You can use marginal cost for production decisions. If the price you charge for a product is greater than the marginal cost, then revenue will be greater than the added cost, and it makes sense to continue production. However, if the price charged is less than the marginal cost, then you will lose money, and production should not expand. The formula for marginal cost can be expressed as follows. Marginal cost equals change in costs divided by change in quantity. For the more algebraically inclined, marginal cost can also be expressed by this equation. Let's apply what we've learned. It costs $250,000 to produce 5,000 items and $340,000 to produce 6,500. You have set the price for each item at $75. Should you increase production from 5,000 to 6,500 items? Marginal cost equals the change in costs divided by change in quantity. Marginal cost equals $340,000 minus $250,000 divided by 6,500 minus 5,000. Marginal cost equals $90,000 divided by 1,500. Marginal cost equals $60. $75 is greater than $60. Since the marginal cost is less than the price you charge per item, you can expand production. Marginal cost is the increase or decrease in total production cost if output is increased by one more unit. The formula to obtain the marginal cost is change in costs divided by change in quantity. If the price you charge per unit is greater than the marginal cost of producing one more unit, then you should produce that unit. If the price you charge per unit is less than the marginal cost of producing one more unit, the unit should not be produced.
Mr. Sweet owns the Sweets R Us company, which manufactures and distributes candy. His company is profitable, but he wonders if all the costs of manufacturing the products are captured and reported accurately. At a recent industry conference, one of his competitors was talking about financial information prepared using absorption costing and internal information prepared using marginal or variable costing. Mr. Sweet would like to learn more about these two types of costing systems and which one he can use for external versus internal reporting. Manufacturing a product involves direct materials, direct labor, and variable and fixed manufacturing overhead. Direct materials represent the cost of materials used directly in the manufacturing process. Direct labor reflects the wages of those employees who manufactured the product. Variable manufacturing overhead varies with the volume of production, and an example would be utilities. Fixed manufacturing overhead include costs that remain the same regardless of how many units are produced, such as the rent that Mr. Sweet pays in his production facility. It's simple to trace direct materials, direct labor, and variable manufacturing overhead costs to a particular product. In absorption costing, fixed manufacturing overhead costs are also allocated to each unit that's produced. As a result, each finished product absorbs all the costs related to its manufacture. Fixed overhead is allocated to each unit produced using the formula fixed overhead rate equals estimated fixed overhead costs for the period divided by estimated activity for the period. Let's assume that Sweets R Us estimates its fixed manufacturing overhead costs to be $5,000 for the month, and it estimates it'll produce 2,500 units of product. The fixed manufacturing overhead rate for this period would be $2 per unit, which is found by dividing the estimated fixed overhead costs by the estimated activity for the period, or $5,000 divided by 2,500 equals $2. In absorption costing, fixed manufacturing overhead is allocated to the finished product and becomes part of the cost of inventory. Inventory represents items where manufacturing is complete, but they haven't been sold to the consumer. Due to the treatment of fixed manufacturing overhead, a higher net income is reported on the income statement, which summarizes revenue and expenses for a particular period. Accounting standards require that absorption costing be used since the cost of inventory must include all purchasing, conversion, and any other costs to get the inventory ready for sale. This includes direct materials, direct labor, and both variable and fixed manufacturing overhead costs. As an example, let's assume the following information for the Sweets R Us company. The sales for the period equal $250,000. The opening inventory is at $0. The manufacturing costs include direct materials at $80,000, direct labor at $60,000, variable overhead costs at $10,000, and fixed overhead costs at $20,000. The ending inventory includes 3,000 units, which equals $51,000. And the selling and administrative expenses equal $60,000. Absorption costing includes all manufacturing overhead, both variable and fixed, and is calculated using the cost of goods sold formula. The cost of goods sold formula is cost of goods sold equals opening inventory plus direct materials plus direct labor plus variable manufacturing overhead plus fixed manufacturing overhead minus ending inventory. Using the information from the Sweets R Us company, we'd get $119,000, or 0 plus 80,000 plus 60,000 plus 10,000 plus 20,000 minus 51,000. The income statement using absorption costing would look like this. Fixed manufacturing overhead is allocated to the units included in finished goods or ending inventory, and its costs will be carried over to the next period until the finished product is sold to consumers. In marginal costing, the cost of a finished product includes direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing overhead is an expense in the period in which it occurs and doesn't become part of the finished goods inventory. For example, let's assume the same information for the Sweets R Us company as before, only now at the ending inventory of 3,000 units equaling 45,000, as fixed manufacturing overhead isn't included. The formula to calculate cost of goods sold under marginal costing is cost of goods sold equals opening inventory plus direct materials plus direct labor plus variable manufacturing overhead minus ending inventory. When this is applied to the Sweets R Us company information, it comes to $105,000, or 0 plus 80,000 plus 60,000 plus 10,000 minus 45,000. Note how this is lower than the $119,000 reported under absorption costing. The difference is due to the inclusion of fixed manufacturing overhead in absorption costing. The income statement will also look differently because fixed manufacturing overhead will be reported as an expense. It would look like this. Note that net income before tax is $6,000 lower using marginal costing. The difference is because fixed manufacturing costs are included in the ending inventory of $51,000 and carried over to the next period when the goods are sold in absorption costing, but they're not included in the ending inventory of $45,000 in marginal costing because they're expensed in the period in which they were incurred. Also note that the contribution margin is calculated instead of a gross margin, since cost of goods sold contains only variable expenses. Direct materials, direct labor, and overhead costs are incurred to manufacture a product. While it is straightforward to trace direct materials, direct labor, and variable manufacturing overhead costs to a product, it's difficult to trace fixed manufacturing overhead costs to a particular product. In absorption costing, inventory cost includes direct materials, direct labor, and variable and fixed manufacturing overhead costs. Marginal costing doesn't include fixed manufacturing overhead in its calculation of inventory, but expenses it in the period in which it's incurred. Accounting standards specify that all costs to manufacture a product must be included in its inventory cost, and therefore, absorption costing is used for external reporting and tax purposes.
Business leaders, investors, and many others examine the financial statements of businesses in order to make decisions. They determine whether to make more or less of a product, hire or lay off staff, raise or lower prices, and they use financial statements to determine if they should invest in a company. For this reason, it's very important that financial statements provide an accurate representation of the assets, liabilities, income, and expenses of a business. Before financial statements can be prepared, an accountant has to determine the period of time covered by the financial statements. Financial statements may only provide a snapshot of the assets and liabilities as of a particular date. For example, December 31st. Financial statements may provide a view of the activity over a month, a quarter, or a year. Whenever a period of time is presented, there has to be a start date and an end date. This means that accountants now have to make sure that expenses are recorded in the right time period. Take rent payments as an example. Your monthly rent is $1,300, and you're preparing an income and expense statement for the period of January 1st to March 31st. You would expect to have 3 months of expenses included. Therefore, your rent expense should be $3,900 for the quarterly statement. That seems pretty easy, and for some expenses, it is just that easy. However, for other expenses, it's more complicated. In accounting, there's the matching principle, which states that any expenses incurred to generate income should be reported in the same period as the income. On the surface, this sounds pretty straightforward. If you spend money to buy inventory that's an expense, when you sell that inventory, it's income. The difference between what you spent to buy the inventory and what you sold it for is the profit. Income minus expenses equals profit. But then, there's this little wrinkle about timing. You may buy the inventory in one period, say January, and sell it in another, say June. So the expenses were incurred in the first quarter, but the sale occurred in the second quarter. If you're doing quarterly statements, how do you match the income with the expense? This is where the concept of separating costs into period costs and product costs originated. Period costs are those costs that are not a necessary part of the process of producing a product or service to be sold. As the name implies, period costs are recorded as an expense in the income statement in the period that the cost is incurred. So, if you pay rent in June, it's recorded in the period in which June falls. The same is not true for product costs. Recognition of product costs in the income statement is delayed until the product is actually sold. Period cost equals an expense now, and product cost equals an asset now and expense later. Let's illustrate the difference between product costs and period costs with an example. Fast Motor Co. has 3 assembly plants, one for cars, one for trucks, and one for SUVs. Fast Co. also has a headquarters building where the executives work along with all of the support functions like sales, HR, marketing, and legal. There are 3 types of cost that occur in the plants. They are product costs. Direct materials that make up the vehicles, like the doors, windows, and engines. direct labor of the working people who put the direct materials together to make the vehicles. Factory overhead, which covers all of the other costs needed to keep the factory running. That includes lease expense, utilities, and the salaries of the plant manager and supervisors. These product costs are attached to the vehicles and become their inventory value. When the vehicles are sold, they will go on the income statement as cost of goods sold, an expense which will perfectly match the revenue from selling them. The expenses incurred at the headquarters, though, can't be attached to any vehicles because they don't make any fast vehicles at the headquarters. So they are recognized on the income statement as period expense. That includes the executive's salaries and all of the expenses incurred in the support departments. To understand period costs, you must understand the principle of matching expenses to the revenues that they generate. Due to the matching principle, some expenses are not recognized in the period in which they're incurred. For example, product costs, while others are recognized when incurred, and these are period costs. In order to properly calculate profit for a period of time, expenses must be allocated in the right time period. When it comes to costs of doing business, companies need to know both period and product costs. They have to be able to collect enough revenue to cover both, or they'll eventually run out of money. Businesses must make sure that their financial statements capture all assets, liabilities, revenues, and expenses related to a time period. Period costs equal a now expense, while product costs equal a now asset, but an expense later.
XYZ Incorporated is a company that manufactures telephone wire for businesses that wire homes and other buildings for their telecommunications needs. They currently have a plant located in Nebraska that employs 100 people, which includes production, support staff, and management. The process of manufacturing telephone wire requires 5 different machines located on 5 different production lines. Before beginning production, XYZ will need to determine what the product costs are. Product costs are all of the costs associated with the manufacturing of a product that is intended for sale to customers. For the purpose of company XYZ, the product costs are direct materials, direct labor, and manufacturing overhead. Direct materials are the raw materials used to manufacture the telephone wire. Direct labor is all of the manufacturing labor required to complete the manufacturing process. Manufacturing overhead are the auxiliary costs to manufacture the telephone wire, such as electricity to run the machines. It is important to note the difference between product costs and period costs. The selling and administrative costs associated with the sale of goods are recorded as an expense. This is called a period cost. This cost is differentiated from product costs because it is not directly related to the manufacturing of the product. This type of expense can occur at any time before, during, or after the manufacturing process, but must be recorded in the time period in which it occurs. This type of expense is completely independent of product costs. The allocation of product costs affects the financial statements of XYZ in different ways. When cash, an asset on the balance sheet, is used to buy raw materials, the raw materials are an inventory asset on the balance sheet. After the manufacturing process, XYZ still has the telephone wire in its warehouse, so the telephone wire is an inventory asset on the balance sheet. When the telephone wire is sold to a customer, the costs moves from the balance sheet to the income statement under Cost of Goods Sold, or COGS. COGS is subtracted from the selling price of the telephone wire to compute the gross profit of the sale. Let's look at an example with XYZ Incorporated, showing the manufacturing process and how the product costs are allocated to financial statements. XYZ Incorporated began Q1 of 2015 with $50,000 in cash. They buy raw materials for $2,000. This is all of the raw materials required to manufacture a batch of telephone wire. On the balance sheet, we add $2,000 to inventory and subtract $2,000 from cash for the purchase. XYZ Incorporated manufactures the batch of telephone wire during Q1 of 2015. They use all of the raw materials on hand. They use all 5 production lines to manufacture the wire. The cost of manufactured goods schedule shows the total of product costs for the manufacturing of the telephone wire. The manufacturing of the telephone wire is completed and recorded on the balance sheet as unsold finished goods. XYZ Incorporated sells the batch of telephone wire for $12,000 during Q1 of 2015. The sale is recorded on the income statement. Selling and administrative expenses are also recorded on the income statement for the sale of the batch of telephone wire. The difference between the gross profit and the total expenses is net profit, the money left over at the end of the day. XYZ made a profit of $7,400 on the sale of the batch of telephone wire. It is recorded as retained earnings on the balance sheet. When a product is manufactured, the product costs associated with it, direct material, direct labor, and manufacturing overhead, are calculated and used by organizations to determine the cost of a product. These costs are recorded in the time period in which the manufacturing occurs, while the selling and general administrative expenses are recorded in the time period in which they occur, regardless of the product costs. All of the product costs are assembled onto a cost of goods manufactured schedule, which is used to allocate costs to the appropriate financial statement.
When you think of a budget, you probably picture a list of numbers that show your income from work or an allowance and all of your expenses, such as car payments, rent, or even video game subscriptions. Like a household, a company must also have a budget. Companies cannot grow without closely following a budget that accounts for expected income and expenses and helps them plan for the future. A master budget in accounting refers to a specific type of document based upon other specialized individual budgets. Individual budgets within a firm can change depending on the type of business. However, they frequently fall under one of the three main categories: operating budgets, capital expenditures budgets, and financial budgets. Operating budgets contain a sales, selling expense, and general and administrative budget. Companies that manufacture goods also have production and manufacturing budgets that include the number of units to be made and the costs associated with production. By comparison, companies that only sell products manufactured by others use a merchandise purchases budget to track the number of units it needs to purchase over time to cover expected sales. The sales budget includes the expected number of sales and projected income for the upcoming period in months, quarters, or years. Companies typically complete this budget first, as it allows them to estimate how much income is available to meet corporate goals. The selling expense budget commonly follows the sales budget. It records the estimated income and predicts expenses directly related to the sale of goods. Examples of direct sales expenses include sales commissions, sales managers' salaries, and advertising expenses. Expenses not directly related to the sale of particular items are accounted for in the general and administrative budget. Costs such as facility rentals, administrative personnel salaries, depreciation expenses, and shared utilities can be found in this budget. Capital expenditures budgets track any money that a business receives from selling large plant assets and buying new equipment to carry out production schedules. Typically, companies try not to keep a lot of cash in their accounts because it doesn't generate a lot, if any, revenue. Planning for large expenditures helps firms decide how they will pay for major equipment upgrades, additional facilities, or other related expenses. This budgetary section may be left out if the company does not have any income or expected expenses related to capital expenditures. Financial budgets include the cash budget, budgeted income statement, and budgeted balance sheet. Cash budgets track the expected income and spending of cash over an upcoming period of time to ensure that a company has enough cash on hand to meet future needs. As previously stated, companies do not like to keep too much cash on hand, especially when the money could be better spent by expanding products, services, and/or a customer base. Budgeted income statements attempt to predict how much a company will earn from sales and how much it will pay in expenses related to those sales. The development of a budgeted income statement is one of the last steps in the master budget process because it incorporates the other budgets. Budgeted balance sheets constitute the final part of a master budget and provide a summary of the company's expected financial status at a future date. Like the budgeted income statement, the budgeted balance sheet uses information from the other budget components. A master budget is actually a combination of many other budgets developed by different departments across an organization. Master budgets typically fall into one of three categories: operating budgets, capital expenditures budgets, and financial budgets. Operating budgets include a general and administrative budget, sales budget, and selling budget. Financial budgets include the cash budget, budgeted income statements, and budgeted balance sheets. Capital expenditures budgets track any money that a business receives and may not be included in every budget. The results show a financial picture of what a company expects to achieve over the course of an upcoming period of time. Information of great use to managers making both long-term and short-term corporate decisions.
Maintaining a healthy business requires careful financial planning and budgeting. Companies use a master budget to manage their cash and other assets and to estimate their future sales and expenses. Master budgets are made up of two parts that work together: financial budgets and operating budgets. Financial budgets focus on cash and capital expenditures. They are used to make sure that the business has the cash it needs to fund its operations and to maintain and/or upgrade its buildings and equipment. This lesson covers operating budgets, which are detailed plans that estimate how much income a company expects to make and what it thinks its expenses will be in the short term, typically within a year. Companies normally use separate operating budgets to create plans for each area of their business. Examples of commonly used operating budgets are sales, production or manufacturing, labor, overhead, and administration. Once budgets are in place, companies can use them to manage activities, compare how they are earning or spending against these budgets, and prepare for future business cycles. Operating budgets offer a way for companies to estimate what their revenues and expenses might be in the immediate future and to make preparations to support any variations. To see how operating budgets work, let's look at an example of them in action. Imagine you own a beach hotel and resort and are preparing operating budgets. You'll begin with the sales budget first, because it affects all the other budgets. The sales budget includes everything that brings in cash: hotel room rentals, restaurant and bar sales, valet and parking revenue, internet fees, and conference room sales. The sales budget is your best guess at what revenue will be coming in for the time period, and you'll need to think through several things when preparing it. At your beach resort, seasonal factors will greatly affect your sales. Hurricane seasons or college spring break schedules will either scare people away or cause them to flood in. Other factors like special events, tourism trends, and economic conditions can also affect the traffic at your resort. Most managers look at the previous year's actual income to estimate sales budgets for the next year. Next up are the expense budgets, the costs of doing business to earn income. In your resort, there will be an operating budget for labor, employees like housekeepers, landscapers, lifeguards, and front desk personnel. There will likely be a budget for marketing and sales, and another for materials such as housekeeping supplies, linens, snack items, beach towels, and newspapers. Overhead expense budgets include costs such as utilities, insurance, mortgages, property taxes, and interest expenses. Some of these expenses will be known, such as mortgages and property taxes. However, as with the sales budget, some will be variable and be affected by a variety of factors. For example, your resort has expenses that are directly tied to revenue and occupancy. As more rooms are rented, more housekeeping and laundry staff are needed. More laundry supplies will be used. Linens must be replaced more frequently, and utilities will be higher. As more guests stay at the hotel, food and other revenues increase. With that increase, correlating expenses such as food and liquor expenses also increase. More cooking and waitstaff will be needed, driving salary expenses higher. Preparation of these budgets will allow you to see how the different areas of your business work together. It will also allow you to answer questions: when to hire additional staff or to cut back, how to plan for maintenance for your air conditioning units, what to charge for rooms and food, etc., in order to cover the expenses of staff, marketing, and overhead and still earn a profit. The revenue and expenses estimated on operating budgets will affect the business currently or in the immediate future. They can be prepared for periods of time that can range from a few months to a full year, depending on the type of project or business and the size of the budget. They can apply to a whole business or just a single project. When all of the operating budgets are combined, they feed into a report called a budgeted income statement, which shows what a company expects to earn and spend over a period of time. Managers use these budgets to evaluate how well departments are operating and how the immediate spending and income of each group is affecting the whole business. Let's review. Operating budgets are used as plans for the sales, income, and production, expense, departments of business, and are generally short-term, 3 to 12 months long. Managers use them to track income and expenses and to evaluate how their business is doing. Preparing operating budgets allows a business to plan for future events and make the appropriate accommodations for increases or decreases in revenue and expenses. Operating budgets and financial budgets are the two halves of a master budget. One of the most important documents that your business will ever create is a sales budget. The reason for this is simple. Businesses exist to make money, and a sales budget shows where that money is coming from. More specifically, the sales budget is a plan for not only how much money should be made for a given period, but where that money is going to come from. As such, a sales budget does a great job of assigning responsibilities and managing expectations. In this lesson, we're going to learn why the sales budget is typically the first budget to be created in a business, look at how to create one, and examine some of the problems that can result with a bad sales budget. As previously mentioned, it is useful to know how much money your business is going to make during a given time period. And that's why the sales budget is one of the first documents that is created for a given point of time. Additionally, it provides information about what expectations your customers will have based off of past performance. A sales budget will let you know just how much of certain goods your customers will demand during a given time period. So how do you create a sales budget? First, figure out the time period you want to look at. Because it is so important, most companies will come up with a sales budget every quarter, if not every month. Now compare this period to the same period in years past. If you are just starting out, make informed guesses as to how well your company will perform. A central part of this is talking to your salespeople. Not only should you make an assumption of sales based from their numbers, but also you should work with them to set expectations. After all, your salespeople know the customers in question and have a handle on how much they will actually purchase. From there, compile your numbers by taking the number of gross sales multiplied by the price of each unit. That gives you the total gross sales. Then subtract the value from any discounts or allowances to get the total net sales. As a note, you should be prepared to do this for each category of goods. Because so much springs from the sales budget, so much can go wrong if it is inaccurate. First of all, many other budgets will be off if the sales budget is wrong. This has a domino effect. Suddenly your HR department is hiring too many people, or your procurement department does not have enough raw materials to be worked. In either event, it ends up costing your firm more money than would have originally been spent if you had just gotten it right the first time. So let's look at a widget company's sales budget in action. Let's say that you are creating a sales budget for the month. First, talk to your salespeople and find out how much they expect to sell. After talking to them, you find that they expect to sell 200,000 widgets. That is your total gross sales. Now multiply that by your price per widget, which happens to be $50. So 200,000 times $50 is $10 million, which is your total gross sales. Finally, you have authorized 5 of your salespeople to offer up $10,000 each in incentives. That means a total of $50,000 must be subtracted from total gross sales. In other words, you end up with $9,950,000 as your total net sales. Those numbers are among the most important that your business will try to predict. If you budget too high in number of units expected to be sold, your firm spends too much money. Likewise, if you don't budget for enough units, your company won't have the inventory on hand to meet its orders. In short, this is why it is so important to get the sales budget right. In this lesson, we looked at the importance of the sales budget. We see that it is one of the most important documents created by a firm and that many other budgets rely on it. That said, it is surprisingly simple. To create a sales budget, multiply the sales price by the number of units sold and then subtract any discounts. This gives you the total net sales. However, if this number is wrong, you can expect costs to skyrocket at other points of your company. A production budget is unique in that it doesn't have any currency listed on it. Instead, it is a guide as to how much a company must produce to meet its sales goals. As such, it is one of the most important budgets that a company will produce, and is second only to the sales budget in being done for a given quarter. In this lesson, learn about creating a production budget, where the numbers come from, and what happens when someone gets it all wrong. To prepare a production budget, first get the number of goods that the company expects to sell in a given period. Often, the same period is used that is defined in the sales budget. That means you'll often prepare a production budget every quarter, possibly every month. With those numbers, add the number of units that the company wants to have in inventory at the end of the period. This gives the total production required. Then subtract any units the company already has in inventory. Remember, inventory means completed but not yet sold to customers. That gives the net number of units that need to be produced that quarter. Also note that a production budget, like a sales budget, will often be prepared for each different good or group of similar goods that a company sells. As you are probably thinking, before a company starts making the production budget, they have to know where all those numbers come from. The most important number, the number of goods that are expected to sell, comes straight from the sales budget. Then use an inventory report to get the number of goods still in inventory. Also, base the desired final inventory off of the desires of the company. Everything else can be deduced from those numbers. So how can a budget that doesn't actually have any currency have the potential to go wrong? The answer is not at all surprising, since the production budget actually informs plenty of other budgets within an organization. What if too many goods were planned for production? Now the company has a direct materials budget that is skewed to buying too many raw materials, resulting in an increase in cost. The same happens to the direct labor budget. Let's look at all this in action. For example, say that you were asked to prepare a production budget for a widget firm. First things first, get your number of units that you expect to sell from the sales budget. Let's say that you expect 100,000 units to sell. However, your inventory report says that you still have 30,000 widgets on hand. Also, you are supposed to keep 20,000 widgets in inventory. Let's crunch some numbers. 100,000 plus 20,000 minus 30,000 gives us 90,000 widgets, which is how many you'll need to produce. A production budget is often the second document that a company's accounting department will produce and is done right after the sales budget. It is also done just as frequently. Instead of calculating dollars, the production budget offers an estimation of how many units of a given good will be needed. It takes into account existing inventory as well as the desired inventory. Despite not featuring money, a production budget has the ability to drastically alter other costs throughout a company, ranging from labor to materials.
Chances are that either on your fridge or on your phone, you have a list of things you need from the store. Maybe it's a few eggs, or perhaps you meant to pick up a new pair of socks. In any event, chances are that this list changes pretty often. Sure, some things are always there, but I'm willing to bet you don't purchase socks every time you go to the store. Companies, on the other hand, tend to buy the same thing over and over again. This is especially true for companies that manufacture something. Because of the fact that they are always buying the same things, they can budget what they'll need in order to make the relevant purchases. The direct materials budget shows how much must be purchased of each raw material in order to meet the orders for that time period. This is a very useful budget, not only from a financial perspective, but also from the perspective of making purchasing decisions. As you might expect, there is a formula for finding the direct materials cost. First, we start by finding out how many raw materials are needed. To do this, take the total amount needed for production and add it to the amount that you need to have on hand afterwards. You'll want to have some extra raw materials on hand to deal with any situations as they emerge. From that number, subtract the amount of raw materials that you currently have on hand. That tells you how much you need to purchase. You would then repeat this for every other raw material that your company needs and multiply them by the respective unit cost of the raw materials to find out what your direct materials cost would be. As you can imagine, this can be maddening to do exactly, so many companies offer their best estimation. The direct materials budget has plenty of use across the company. Obviously, it has a place in the procurement department, as it tells the company how much of each raw material is necessary in order to meet relevant orders. It's also useful for the people in the distribution department, so they can see what transportation needs are required. Still, it's in the accounting department where this budget is most acutely felt. Master budgets are impossible to create without having access to the numbers found in the direct materials budget. Likewise, The numbers found in the direct materials budget help to make sure that the balance sheet is correct. After all, the balance sheet has to show the total inventory on hand, and the direct materials budget is a source of that information. Finally, the direct materials budget helps to prepare the budgeted income statement by providing information necessary to ensure the plans are financially possible. Let's take a look at the direct materials budget in action. You are the production manager for a widget firm and have been tasked with preparing the direct materials budget for this month. You have to make sure that you have materials on hand for 20,000 widgets. 1 ton of raw materials can produce 1,000 widgets, and you have 5 tons of materials on hand. Additionally, you should have 10 tons of raw materials on hand at the end of the month. Finally, each ton of materials costs $10,000. So, how do we write our budget? First, we figure out how many tons of materials we need for production and how many tons we need to purchase. We need to create 20,000 widgets, and since each ton makes 1,000 widgets, that means we need 20 tons of raw materials. Since we want to have 10 tons on hand afterwards, we add 10 to 20 to get 30 tons we need for production. However, we already have 5 tons on hand, so we can subtract that from the 30 to get 25 tons. In short, we need to purchase 25 tons of raw materials for our widgets. But wait, where's the money part? After all, this is a budget, right? That's easy enough to add. Remember that each ton of raw materials is $10,000. Multiply the total amount of tons needed by the cost per ton, and we get $250,000 as our direct materials cost. In this lesson, we learned how to use the direct materials budget. Remember that the direct materials budget shows us the direct cost of raw materials associated with creating goods. It is useful not only for purchasing goods, but for also anticipating storage and logistics needs. To find the direct materials cost, we take the total amount of materials needed, add any carryover requested for the next term, and subtract what we already have on hand. We then multiply that answer by the cost per unit of raw materials for our direct materials cost.
Business accounting is quite different from just balancing your checkbook at home. After all, a typical company usually has much more money to manage than the average American household. However, it also has many more expenses, and those expenses have to be accounted for in very specific ways. This is not only for the purposes of tax reporting, but also because good managers want to know where their money is going. As a result, firms must prepare specific budgets for different areas of expenses within their companies. One of the most common examples of this type of budget is a direct labor budget. A direct labor budget keeps track of all the labor-related expenses as they directly relate to manufacturing. In this lesson, learn how to prepare a direct labor budget, as well as how it factors into other types of accounting documents. First things first, make sure there is access to all the numbers needed to prepare a direct labor budget. To find those, start by looking at the production budget, which shows how many units have to be manufactured. In addition, find out the hourly cost of labor and the amount of labor needed to manufacture each unit. From here, it is just a matter of multiplying these numbers together to find the total labor cost. First, multiply the total number of units by the cost in time to produce each unit. That will give the total number of hours necessary. Then multiply that by the cost per hour for labor to get the total labor cost. Of course, companies rarely make one product that just has one set amount of time necessary to build it, nor do they typically pay everyone the same. As a result, direct labor budgets often break down the labor cost for each type of good created by a company, taking into account the different wage costs and different time commitments associated with each. As stated, the direct labor budget borrows heavily from the production budget to get its figures. However, it doesn't stop there. The total labor cost as calculated in the direct labor budget is crucial to being able to calculate a company's master budget, as well as its balance sheet and budget income statement. Both of these help to make sure that a company can meet its bills and continue to produce goods. However, it's not just an accounting tool that the direct labor budget offers its worth. It can also be used by human resource managers to help anticipate when a company may need to make new hires, as well as in determining how much vacation time to award each year. In fact, the direct labor budget can even help determine approval of vacation at times when too many people have requested off from work. Here's an example of using a direct labor budget and how it works. Say that you own a widget factory. You've just been awarded a contract to produce 100,000 widgets, and you need to know not only how much it is going to cost you in terms of labor, but also if you'll need to hire more people. The direct labor budget helps with both. First, what information do you need to calculate the budget? Well, it takes 500 workers each 15 minutes to construct a widget. Each worker gets paid $15 an hour. The buyer expects the widgets to be done in 1 week. Now let's take a look at the math. How much is it going to cost the company? Multiply the number of widgets by the time in hours needed to make one by the pay per hour. That's 100,000 times 0.25 hours times $15. You end up with $375,000 as your cost. However, you still need to know if you're going to have to hire new people to help you achieve that goal. Stop before multiplying the wage. That gives us 25,000 hours. Now divide that by your total number of hours each employee works during a week. Most firms have their employees work 40 hours a week. 25,000 hours divided by a 40-hour work week equals 625, which is how many total employees you would need to produce all those widgets on time. Since your company has 500 employees, that means you need to hire 125 new employees as temps for that week. The direct labor budget is an assessment of all the labor costs directly associated with producing a good. However, beyond its use as an accounting tool, the direct budget is also useful for planning human resources. Remember that the information needed for a direct labor budget starts with the production budget, and this budget is necessary to calculate a company's master budget, its balance sheet, and budgeted income statement. In order to find the direct labor cost, multiply total production by time per unit by cost per labor hour.
If you want to successfully run your own manufacturing company to make the products you sell, you need to have a working manufacturing overhead budget. This type of budget shows you just how much it costs you to run your manufacturing facility. It doesn't include your materials cost or the employee cost to make your products. That goes on other budgets. What this budget helps you with is seeing just how much you need to spend per month or per quarter to keep your facility running. Now, imagine that you have your own manufacturing company that makes all kinds of pillows for people. You found a way to automate the making of these pillows in any shape that customers want, so people can order donut-shaped pillows or dog-shaped pillows. To keep on top of your manufacturing company, you have a manufacturing overhead budget. What did you have to do when you prepared your manufacturing overhead budget? Let's see. Budgets shouldn't be too complicated, nor too simple. They need to capture all the costs associated with the particular budget. So, for your manufacturing overhead budget, you need to capture things like the rent and utilities for your manufacturing facility. You also need to consider the maintenance cost along with the depreciation of your manufacturing equipment. Another part of your manufacturing overhead budget is the cost of your freight shipping, including the cost to send out your finished goods to your stores, as well as the cost to move your finished goods from the manufacturing facility to your warehouses. Your manufacturing overhead budget also includes employee costs needed to run the manufacturing facility. Remember that employee costs to make your products are not included in this budget, so employee costs here are for the maintenance and upkeep of the manufacturing facility itself. Your facility needs employees to keep it clean, to keep the machines maintained, and to handle the financial aspects of running it. For your pillow manufacturing facility, your manufacturing overhead budget might look like this. In this example, you've broken up your costs by quarter. These budgets are usually calculated either per month or per quarter. You can see that your costs for the fourth quarter were a little bit higher. This was because you had more finished goods to move around for the holiday season, so your freight costs were a little more the fourth quarter. You can also see that having a manufacturing facility is fairly costly. Once you've calculated your manufacturing overhead budget, you can now use it in your other budgets. One other budget that your manufacturing overhead budget is part of is your master budget. Your manufacturing budget is part of the master budget's cost of goods sold line item. Your manufacturing overhead budget can also be used as part of the calculation for your cost of ending finished goods inventory. It is also used to directly calculate your overhead percentage. This percentage shows how much of your sales go towards the operation and maintenance of your manufacturing facility. To calculate this, you take your manufacturing overhead budget for a specific time period, such as quarter 4, then divide it by your sales for that same time period and multiply it by 100. For your pillow facility, say you had total sales of $123,000 for quarter 4, then your overhead percentage for that quarter would be calculated like this. $32,500 divided by $123,000 equals 0.264. 0.264 times 100 equals 26.4%. This tells you that even with sales of $123,000 for the fourth quarter, running your manufacturing facility still takes away a good chunk of your sales. In this case, it takes up slightly more than a quarter of your sales. Ideally, you want your overhead percentage to be as low as possible so you get to keep more of your profits and use it to build and grow your company. Let's look at another example. Here's a look at the manufacturing overhead budget of a small manufacturing facility that produces little glass jars. Looking at this manufacturing overhead budget, you see again that the fourth quarter costs are the highest. Because it's a small manufacturing facility, the total costs for each quarter are not as high as your pillow manufacturing facility. The fourth quarter budget is higher for this facility because the administrative costs were higher due to the year-end bonuses, and the freight cost was also higher due to holiday season increases in manufacturing. Let's review. The manufacturing overhead budget shows you just how much it costs you to run your manufacturing facility. To prepare one, you need to have the following information on hand: rent, utilities, equipment maintenance costs, equipment depreciation, freight shipping, employee costs needed to run the facility, anything else related to the running of your manufacturing facility. The only things that are not included are the cost of materials and the employee costs related to the making of your products. These are listed on other budgets. Your manufacturing overhead budget is used as part of the master budget's cost of goods sold line item and can help with part of the calculation for the cost of ending finished goods inventory. You can also use it to calculate overhead percentage, which shows how much of your sales is needed to run your manufacturing facility.
A great deal of planning goes into creating the goods that we purchase. Companies have to create many different budgets related to the manufacture of goods, ranging from sales and production budgets to direct materials and direct labor budgets. But what about expenses that a company incurs that are not directly related to manufacturing? These expenses are expressed in a selling and administrative expense budget. This wide-ranging budget accounts for many of the expenses of most companies. In this lesson, we'll see what goes into a selling and administrative expense budget, as well as how it influences other documents. Think about a typical business. There's a lot it has to pay for beyond labor and materials. It also has an accounting department, custodial team, advertising bills, and of course, executives. Yes, the selling and administrative expense budget is where those cushy washrooms and corporate jets are accounted for. And there's more. The selling and administrative expense budget also covers any business insurance that the organization has, as well as rent or mortgage payments for service department sites. Note that this budget does not include rent or mortgage for production facilities. Additionally, the selling and administrative expense budget includes taxes ranging from payroll to property. In short, anything that doesn't appear on the direct labor, direct materials, or materials overhead budgets appears on the selling and administrative expense budget. There is one exception, however. Any requirement for the company to keep cash on hand does not appear on the selling and administrative expense budget. After all, it's still on hand, meaning it hasn't yet been spent. As a result, it appears elsewhere in the company's paperwork. So how does a selling and administrative expense budget get put together? Well, first, define a time frame. More often than not, these budgets are completed every quarter, so we'll use that as our standard. Next, make a list of all selling and administrative expenses incurred by your company during a given quarter. For example, let's say you're building a selling and administrative expense budget for a widget company. In the first quarter, it might spend $100,000 on advertising, $200,000 on accounting, $200,000 on janitorial services, $50,000 on utilities, and $400,000 on salaries. You would list all of these in your budget. Then you would add them up to get the total amount for the quarter in question. In our example, that would be a total of $950,000 per quarter. Given the relatively wide areas of responsibility on a selling and administrative expense budget, it's not a surprise that it appears on many other documents that are crucial to a business. For example, it's a line item on the budgeted income statement, just after the gross profit margin of the firm. Remember that the budgeted income statement compares how a company expected to perform with how it actually did. When subtracted from the gross profit margin, the selling and administrative expense budget gives the net operating income of the company. Additionally, the selling and administrative expense budget makes an appearance on the budgeted balance sheet, although you have to know where to look. Remember that the budgeted balance sheet gives us an idea about the finances of a company during a given year. The purchases budget and schedule of cash payments are used for the current liability section of the budgeted balance sheet. In this lesson, we looked at the selling and administrative expense budget, which acts as a catch-all budget for business-related expenses that aren't contained in the direct materials budget, the direct labor budget, or the manufacturing overhead budget. It includes everything from accounting expenses to certain taxes, as well as payments for company executives and payments for office space. We also learned where to use the selling and administrative expense budget on both the budgeted income statement and budgeted balance sheet.
In a perfect world, Versace would be a great place to live. Unfortunately, it's not in the budget. Corporations, like people, are limited by their budgets. What do you do when you have a limited budget? You figure out the best ways to spend what you have to get what you need or want. For a business, that may be new equipment. When corporations figure out ways to get what they need or want, it's called capital budgeting. So corporations conduct financial analysis to determine whether an investment or project is a good idea to pursue. Since the main purpose of a corporation is to make money, it's important to wisely choose which opportunities to pursue. There are several factors that a corporation needs to understand in order to make a capital budgeting decision. They need to understand their cash flow. That is the amount of money that goes into and out of a business. How much money do we have? Corporations also need to understand the financial implications of an investment. How will this capital expenditure, money spent on projects and investments, affect us now and in the future? Once they understand the financial implications of an investment, they need to understand whether it's a good investment for them. So they need to understand their criteria for making an investment. What do they hope to gain? How much do they want to spend? What outcome would make this a good or bad investment for them? There are several common techniques that corporations use to determine how money is spent. This lesson will discuss 3 techniques: payback period, net present value, and internal rate of return. The payback period is the easiest to calculate. A business that wanted to buy a new piece of equipment might use this technique to make a capital budgeting decision. The payback period is the amount of time that it takes for an investment or project to pay for itself. For instance, the equipment costs $5,000 to purchase and will potentially earn $1,000 in profits a month. The equipment will pay for itself in 5 months. How easy was that? You just need key pieces of information, such as the cost of the machine and how much profit it could produce over a specific period of time. The downside of using the payback period technique is that it does not account for the time value of money. That means that money is worth more today than it will be in the future. Money has a time value for 3 reasons. The first reason that money has a time value is that in the future you will need more money to buy the things that you buy now. This is called inflation. Money also has a time value due to uncertainty. The longer it takes you to recoup the money you have spent, the more uncertain it becomes that you will get it back. The final reason that money has a time value is due to opportunity cost. More than likely, there will be alternative opportunities for you to invest in. Having cash in hand today to invest in another opportunity is more valuable than the cash you will receive in the future. Unlike the payback period technique, the net present value and internal rate of return do factor in the time value of money. They're a little bit more complicated than the payback period to calculate, but they are more accurate. The net present value compares the outgoing cash associated with a project or investment with the discounted cash flows expected to be generated by the project or investment. For instance, assume a business owner is looking into a project requiring a $243,000 initial cash outlay. She expects the project to generate $50,000 cash every month for 12 months. Using a discount rate of 12% based on her cost of capital, the discounted total of the returns on the project is $562,754. Using net present value, the project will earn $562,754 minus $243,000, which equals $319,754 in profits. Related to the net present value is the internal rate of return, which is the discount rate at which the net present value is 0. Once the discount rate is calculated, it can be compared to a hurdle rate, like 12% in the previous example, to see if the project has a greater percentage return than what it will cost. Let's review the main points of this lesson. There are several vocabulary words that you should remember. Capital budgeting is the financial analysis that corporations conduct to determine if they should pursue a potential investment or project. Cash flow is the money that goes into and out of a business. Capital budgeting decisions should be based on 3 things. How much money do we have? What is the financial impact of the opportunity? What are my criteria for investing in this opportunity? 3 capital budgeting techniques are payback period, net present value, internal rate of return.
A company's budget doesn't just magically appear. Hours of work go into making it the best document it can be, and many things influence the process. Different departments within an organization jockey for pieces of the budgetary pie, and different priorities within a company receive varying amounts of support. But what about the meat and bones of the budget process itself? How do we decide which groups get line items in a budget? And how do we decide how much to spend on each group that we identify? Clearly, making a budget takes quite a bit more work than just scribbling some numbers on a piece of paper or balancing a checkbook. In this lesson, we'll look at some influences on budget process. We'll start by examining the role that organizational structure plays in the budgeting process, and move on to explore why classification as a profit center, cost center, or responsibility center matters. Organizational structure is how a company is composed. There are 2 approaches to budgeting that are controlled by organizational structure. The first of these is a top-down approach. In this case, a company's upper management dictates exactly how much money should be spent by each part of the organization. This has some obvious advantages and disadvantages. First, there's the very real chance that upper management could give your department more money than you would have otherwise thought to ask for. This might mean that you could operate under budget, or that you could expand your operations. However, the top-down approach could also leave little room for negotiation if you see something that corporate doesn't. On the other hand, there's the bottom-up approach to budgeting. This is when departments get to submit their budgets to upper management for approval. Obviously, this allows department heads to have more latitude with their work. However, it also slows down the budgetary process, as well as leaves room for some to complain of favoritism. So where is all this money going? Businesses have responsibility centers that are the recipients of budget items. A responsibility center is a part of a business that has a manager and its own clearly defined goals. For example, a company's accounting department is a responsibility center, as is its human resources department. By using responsibility centers as the focal point of budgeting, companies are able to clearly state what they expect in return for the money they assign. For a manufacturing division, it might be a certain amount of production. For an accounting department, it might be keeping the books balanced. In any event, the manager of each responsibility center is ultimately the one responsible for the performance of that area. In a top-down budget, the manager simply keeps corporate officers informed so they can make the best allocation decisions possible. In a bottom-up budget, the manager is responsible for making sure the budget request features everything that is needed for that department. Still, not all responsibility centers are created equal. There are 2 main classes of responsibility centers. The first is cost centers, which are parts of a business that make budget requests with no hope of making any direct profit for the company. No matter how good your maintenance department is, there's no chance for it to bring in a profit. Sadly, the same goes for your accounting department. Instead, these parts of the business should aim to minimize total costs. This is part of the reason that cost centers are often outsourced to other companies. However, they can't be neglected because they do have an indirect effect on the profits of a firm. Meanwhile, profit centers are those parts of a company that do make direct profits. The sales department is an excellent example of a profit center. While cost centers are told to minimize their requests, profit centers can make larger requests, as long as they can prove that those requests will help the total profitability of the firm. An accounting department rarely gets a budget to charge expensive company lunches and dinners to the business, but the sales department often does. This is because those meals can help the profitability of the company. In this lesson, we looked at influences on a company's budget. We saw how budgets could be formed through either a top-down approach, in which corporate management tells departments their budgets, or a bottom-up approach, in which departments make budgetary requests. We also looked at different types of responsibility centers, those parts of a company that make budgetary requests and have duties to perform, seeing how profit centers are expected to maximize profits, while cost centers need to minimize costs.
If a business had access to a crystal ball that could tell the future, it is likely that many managers would have the same question: is my company going to make money this year? While the physics of crystal balls are still iffy for this sort of prediction, there is a financial form that allows managers to ask the same questions. Known as the budgeted income statement, this document is a prediction based on other forecasts and budgets of what a company's bottom line is going to look like in the future. In this lesson, we're going to learn how to make a budgeted income statement, as well as review many of the reasons that this is such a useful document. Let's start with how to make a budgeted income statement. As far as financial statements go, a budgeted income statement is pretty straightforward. We start by taking the net sales figure for the period, which we can find from the sales budget. From that, we subtract all of the costs associated with making the goods that we sold. We find that number by multiplying the number of units to be sold by the cost of those units. From there, find the gross margin. We then subtract all the selling and administrative expenses found on the selling and administrative expense budget to get the net operating income. This is often a much smaller number than what we started with. However, we're not done yet. Finally, we subtract any interest payments found on the financing budget in order to end up with what we're really after, the net income. This is the total amount of money that the company made as profit during the period after everything else has been accounted for. So let's see how a budgeted income statement looks in practice. Let's say that you were asked to create a budgeted income statement for a widget company. During the month that you are examining, you had net sales of $2 million. You sold 40,000 widgets during that time, each of which cost $20 to produce, making your total cost of widget production $800,000. That means that you have to subtract $800,000 from that $2 million to get $1.2 million, which is your gross margin. You also had $700,000 in selling and administrative costs. That means that you subtract that from the gross margin and get $500,000. Finally, subtract $100,000 in interest payments, and you end up with $400,000 as your net income. Not a bad month, but definitely not the $2 million in sales that you started with. Note that each of these amounts is a line item on the budgeted income statement. By using the budgeted income statement, we can quickly get an idea of the financial health of an organization. There's a lot that can be told from a relatively short document. We can see if costs are being met by profits, as well as see if continued spending on administrative expenses is practical. Managers can even make a determination about if a company can expand operations by taking on more debt. However, it's not just information that can be gleaned from the budgeted income statement. A great deal can also be learned through analysis. By looking at budgeted income statements from multiple accounting periods, we can track major themes in expenses. For example, if a company pays out bonuses that fall under administrative expenses, we can schedule those for a time of the year in which profit margins are expected to be higher. In this lesson, we learned how to use a budgeted income statement. Remember that a budgeted income statement is a financial form that is a prediction based on other forecasts and budgets of the performance of a firm in the next accounting period. The budget is made by looking at information from the sales, administrative, and financial budgets. Finally, it is useful for not only noticing quick facts on each period, but also for spotting trends across multiple quarters and years.
Companies are constantly looking for ways to expand their operations or make them more competitive, but doing so requires a certain amount of planning. The planning for such capital expenses, or those expenses that make a company more competitive or have great abilities, are recorded in the capital expenditure budget, which, generally speaking, is a useful tool when planning how to spend money on capital expenditures, those expenses that will ultimately make the firm more money or more efficient. For a company that is looking to overhaul its equipment or make major changes to its scope of potential operations, the capital expenditure budget is one of the most important documents that can be produced. In this lesson, we'll look at how they are made, as well as how they interact with other financial documents within an organization. Before we start writing a capital expenditure budget, we first have to know what our planned capital expenses are. To do this, planners have to consider where the most pressing needs are for improvement, how advances in technology are most likely to help them, and what the needs of the business are for the coming year. Think about it like this. If you were considering upgrading your computer, you would likely do so if you actually planned on using your computer. Otherwise, it would just be a waste of money. From there, each potential investment is listed, along with the cost and time of year when it is to be purchased. For continuing investments, the cost is split up in accordance to how it will be spent. The capital expenditure budget doesn't have very much influence on many of the budgets within an organization, simply because it has little to offer them. This is why you don't see it mentioned on the sales, production, labor, or materials budgets. Instead, the place you're most likely to see the figures from the capital expenditure budget make an appearance as a line item on the master budget, the central budget to which all other budgets contribute. However, it's not only as a capital expense that capital makes an appearance. It's also interesting to note that it appears as depreciation. Here on the master budget, depreciation is the value of the capital expenses once paid contributing back to the business. As a result, it's often shown as a positive number. Just because the capital expenditure budget only contributes directly to the master budget does not mean that it is not important on other financial documents. Namely, it is important in constructing the budgeted financial statement, a characterization of the financial health of a company. This is because it is useful to know what major expenses are on the horizon when looking at the finances of a company. Likewise, the capital expenditure budget also lends its data to the balance sheet, a list of all the assets and liabilities of a company. Here it is often labeled as an asset, if spent, or as an account payable. Let's review what we've learned. First, we have to remember that capital expenses are those expenses that make a company more competitive or have great abilities. Then we can understand a little easier what the capital expenditure budget is and what role it plays on other financial documents. We saw that it's a useful tool when planning how to spend money on capital expenditures, those expenses that will ultimately make the firm more money or more efficient. Information from the capital expenses sheet informs the master budget, the budgeted financial statement, which is a characterization of the financial health of a company, and the balance sheet, which is a list of all the assets and liabilities of a company.
Your resume tells a story about your professional career. Your social media pages tell a story about your personal life. And your permanent record at school may very well have told a story about your life as a troublemaker. However, few documents tell quite the story for a business as a budgeted balance sheet. In short, a budgeted balance sheet presents a concise view of the company's assets, liabilities, and the amount of equity held by shareholders. It shows not only what a company has, but also where it expects to be going. In this lesson, we'll learn how to build a budgeted balance sheet by walking through the major sections. We'll examine where each section gets its numbers from, and then see how the whole thing comes together. Along the way, we'll look at a widget company's budgeted balance sheet to see how it all works. At the start of any budgeted balance sheet are the assets. There are two types of assets, current and fixed. Current assets are the property owned by a company, in whatever form that may take. At the top is often a reference to cash on hand, taken directly from the cash budget. Next are any accounts receivable, meaning the bills that a company expects to collect on. Finally, inventory is factored in. The sum of these assets gives us the total current assets. However, that's not all the assets that we have. Additionally, there are also fixed assets. These include the worth that a company has built in its equipment and through depreciation. Many of these numbers come from the capital spending budget. Fixed assets combine with current assets to give us the total assets of a company. Let's take a look at a fictional widget company. Their current assets are $10 million. That comes from $4 million in cash on hand, $5 million in accounts receivable, and $1 million in inventory. Meanwhile, $30 million is held as fixed assets, largely through the $5 million in depreciation and the $25 million in the factory itself. That means that our company has $40 million total in assets. The next section contains the liabilities. Liabilities are those debts that a company owes. The first of these is often the accounts payable, which is the sum of the expenses in the selling and administrative expenses budgets, the materials budget, the labor budget, and the overhead budget. Next, we have notes payable, which is a number taken from the financing budget that shows how much money should be paid toward debts. The sum of all of these is the total current liabilities. Back to the widget company. We only have $10 million in accounts payable, but we have another $5 million in notes payable. That's a good sign. Much of our liabilities come from notes payable, namely a major expansion to the factory that's still being paid for. Therefore, we have only $15 million in total liabilities. The next section is a bit tricky. Often called shareholder equity, it's the difference between the total current liabilities and the total assets. This is the worth of the company. Ideally, this is not a negative number. When added to the total current liabilities, it provides the total liabilities and equity. This number should always equal the total assets, simply because all monies held by a firm are either there to meet a liability or to act as value for the owners, or in other words, equity. For our widget factory, equity is the easiest to calculate. Simply take the total assets, $40 million, and subtract total liabilities, $15 million. That means that we have $25 million in shareholder equity. In other words, our company has value for our shareholders. In this lesson, we looked at how to construct a budgeted balance sheet. We learned that this form provides much of the story of a company, just like a resume tells the story of a person's professional career. The first section of a budgeted balance sheet shows assets. This includes not only current assets like cash or accounts receivable, but also the value of the fixed assets of a company. Then, liabilities are deducted. Namely, these are accounts payable and any money owed on debt. The difference between all liabilities and the total assets is called stockholder equity, which you hope is not a negative number.
Before more recent technology was invented, surveyors would chisel a horizontal mark in a permanent structure, where a tool could be placed in the indentation to help create a benchmark with a level rod, helping them and future craftsmen to have a point of reference for building. In the business world, companies use benchmarking as a point of reference as well, but instead of having physical benchmarks carved in stone, they use benchmark reports as a way to compare themselves to others in the industry. Benchmarking is the practice of a business comparing key metrics of their operations to other similar companies. You can also think of a benchmark report as a dashboard on a car. It is a way you can quickly determine the health of the business. Much like a dashboard where you can check your speed, gas level, temperature, a benchmark report can examine things like revenue, expenses, production amounts, employee productivity, etc. Benchmarking occurs across all types of companies, including private, public, nonprofit, for-profit, as well as industries, e.g., technology, education, manufacturing. Many companies have positions or offices in the company that are in charge of benchmarking. Some of the positions include institutional researcher, information officer, data analyst, consultant, business analyst, market researcher. Companies use benchmarking as a way to help become more competitive. By looking at how other companies are doing, they can identify areas where they are underperforming. Companies are also able to identify ways that can improve their own operations without having to recreate the wheel. They are able to accelerate the process of change because they have models from other companies in their industry to help guide their changes. Best practices. This is a benchmark report where companies choose to look at a company or companies that they aspire to be like. By choosing companies that are on the leading edge of the industry, they can identify best practices that help improve their own company. Peer benchmarking. This is a benchmark report where companies choose to look at other businesses very similar to themselves. This allows companies to make sure they are staying competitive with similar businesses. SWOT. This is a type of benchmarking report where companies gather data by looking at strengths, weaknesses, opportunities, and threats to help understand their climate. Collaborative benchmarking. This is benchmarking as a part of a group. Many industries have associations they can join, e.g., the Association of Information Technology Professionals, the National Education Association. These collaborative associations allow for members to provide information to the association. The association can then provide benchmarking and best practice reports for the membership. Step 1. Determining benchmark focus. During this phase, the company determines the specifics of the research project, e.g., which companies they will include in the research, what types of metrics they will compare. Step 2. Planning and research. During this phase, the company puts the resources together to implement the project, e.g., develop surveys, seek cooperation from other companies, find databases already available. Step 3. Gathering data. During this phase, the data is collected through the methodology determined in the planning and research phase. Step 4. Analysis. After gathering the data, the company uses statistical techniques to examine and create the findings. Step 5. Recommendations. After analyzing the data and areas where the company can improve, recommendations are developed. Step 6. Implementation. After reviewing recommendations, the company implements those that are feasible. Step 7. Continual improvement. The benchmarking process is a continual one. After implementing the recommendations, companies continue to benchmark and make improvements to stay competitive in the marketplace. As an example, let's imagine that while going to school, you take a part-time job at a local pizza parlor. Your boss finds out that you are majoring in business, and he asks you to help him understand how well his business is doing compared to the other local pizza businesses. One of the key questions he has is where he fits among the competition concerning the size of his business. One of the metrics you decide to benchmark is the average number of pizzas sold daily. You find 5 other similar pizza businesses within the same town as yours and are able to convince them to participate in your study after promising them a copy of the results. You create a survey including a question that asks the number of pizzas they sell on a daily basis. From this data, you are able to share with your boss that his company is at the lower end of production, with 3 companies selling more pizza daily and 1 selling fewer pizzas. Luckily, you have also benchmarked hours of operation and are able to show your boss that he closes an hour before most of the competition. By opening an additional hour, he may be able to increase the number of pizzas sold. Benchmarking is an important tool for companies to help them improve and stay competitive in the marketplace. Benchmarking always starts with a research question and ends with recommendations and successful implementation of things that will make the company stronger. Benchmarking is a continual process that, if done properly, will keep companies competitive and successful.
Meet Tess. Tess owns a large company where they make cosmetics. After 5 years in the business, Tess now employs over 100 people. While her staff do a great job, Tess has been struggling to find a way to make sure the performance of her workers matches the goals and the objectives for her company. What Tess is actually looking for is a balanced scorecard. What's that? How can it help a company better align actual performance with what they envision? Before we dive much further into this topic, let's define some key terms. First, a balanced scorecard is a system that helps a company match performance and activity to the objectives and goals of the organization. It also helps enhance communication and meet visions and strategies of the company. Key performance indicators, also known as KPIs, are metrics for a company to understand and manage their growth. It is basically a way for a company to look at certain factors, which differ depending on the company, to see they are making progress. When using a balanced scorecard, there are 4 perspectives that help guide the measurement of progress. They are as follows. Financial perspective. Management tracks and keeps record of the company's financial well-being. Metrics for this perspective include making sure companies stay on budget and are doing well as far as profit is concerned. Internal business process perspective. The next perspective involves tracking the actual business activities. Are we meeting customer demand? Are we being productive? Customer perspective. Every company knows that if a customer is not happy, they will go elsewhere. Metrics include recognizing the target market and what products or services they are looking for. Learning and growth perspective. This is the perspective that focuses on training and ideas on how to improve. Training employees is crucial in ensuring a company is efficient and meeting objectives. Metrics help to fund training and can even include mentors and tutors. Let's take a look at an example of the perspectives applied to our company from earlier. To illustrate a financial perspective, let's say Tess is looking to make greater profits for the year. One way to do so is to cut cost. Tess has identified a way to save on packaging by wrapping her products in paper instead of hard plastic containers. This should ultimately decrease her expenses and increase her revenue. Now for the internal business process perspective. To enhance their new packaging, her company will do research on the best types of paper products that are environmentally safe and keep the products fresh. This helps her company align with its goal of being green and offering the highest quality. When looking at Tess's beauty supplies from a customer perspective, Tess will offer her products at a lower price to ensure that her customers will continue to buy the products without the fancy plastic container. She can use her comment cards to measure how satisfied her customers are despite this new change. And finally, the learning and growth perspective motivates Tess to offer training to her employees on how to properly package each cosmetic piece. She will also offer free samples to each of her employees as an incentive. A balanced scorecard is a way for a company to align its business practices with its visions and goals. This is done using key performance indicators so that a company can monitor their growth. There are 4 perspectives that use metrics to better help a company reach their goals. Those perspectives are a financial perspective, an internal business process perspective, a customer perspective, and a learning and growth perspective.
A balanced scorecard is an aid for measuring business performance for the purpose of meeting goals and making changes to behaviors to meet these goals. The scorecard helps track all areas the business finds important to measure. For instance, a business may want to know how many customer transactions there were for each day, and it may want to see trends and make sure enough transactions are being done. In addition, the business may want to track and measure sales performance for each transaction. It may also want to know what the customers think. Overall, the balanced scorecard serves as a simple, clear, and precise way of measuring goal accomplishment. Many businesses, nonprofit organizations, and even government organizations, such as hospitals, banks, universities, and towns, use a balanced scorecard. Each business or organization has a purpose that can be used to understand what aspects need to be measured, and there are many different points of view that can be measured. Therefore, the specific business or organization determines the most important things to measure to reach its aims. For example, a nonprofit entity can use a balanced scorecard to keep track of people's opinions. Nonprofit organizations have many supporters that keep their organizations alive, so the scorecard can be a good tool to both manage all their supporters and determine the best ones. Many businesses use the balanced scorecard to measure their operations, customer-client service, finances, goals, employee development, and internal strategies. If used properly, the balanced scorecard can be used as a way to run daily operations, monitor progress, and manage and save information. For instance, a sales company has a mission to provide customers with the best products and solutions. This company may use the balanced scorecard to understand customer behavior, track employee performance and behaviors, track what products customers bought and why, keep count of the number of products sold, track the company's progress towards goals, analyze the way the company is run in every department, and measure profit growth. Let's take a look at an example of a balanced scorecard being used in a financial institution. Sam is a director of a financial institution, and one of his jobs is to check branch performance on a monthly basis. Additionally, he has to check year-to-year performance and see how branches are doing, what needs to be changed, and what areas need more focus. Luckily, Sam's management team thoroughly uses the balanced scorecard to track performance. One of Sam's employees checks the scorecard daily and weekly to ensure he is on track to meet his personal goals, and the manager checks the branch's performance in sales, operations, volume, and customer service. During one of these checks, one branch found a lack of transactions, poor sales performance, and unacceptable customer service results. The category for operational excellence was borderline failing. The director took action, and behaviors and methods were changed. All employees were asked to keep a tracker along with the balanced scorecard to make sure that the results matched and that they were on target on a daily basis. Now we'll take a look at the example of a small bank that began to incorporate a balanced scorecard in order to keep track of customers' information, bank performance, and employee performance. Employees were able to log in daily and check their performance based on different measures. They were also able to see how they did month to month, which helped them track their progress and change their methods based on goal achievement. The banker used the scorecard to work towards meeting his goals. In addition to monitoring goal achievement, his manager used the scorecard to check that clients were happy, that employees were following methods and were up to date on training, that the areas of operations were sound, and that the branch wasn't underperforming or losing money. Finally, we'll take a look at a non-profit charity that used the balanced scorecard to measure the volunteers' performance and attitudes. This organization also measured the goals and how close it was to its goals, and it checked to make sure it wasn't going over budget. The charity also checked to see which supporters helped more and why, which was helpful to know because the entity could appeal to that particular group more. As a result of using the balanced scorecard, the charity was able to find many supporters. In conclusion, many businesses, organizations, and governments use a balanced scorecard, which is an aid used to track and measure important areas that help the entity meet its goals. The balanced scorecard is a simple, clear, and precise way of measuring goal accomplishment, so many organizations use it to measure operations, finance, goals, and strategies. When an organization considers its unique needs and what it wants to have measured, it can use a balanced scorecard effectively to help improve performance.
Imagine somebody gives you an apple. No, not that type of apple. An AAPL, one share of stock in Apple Inc. Congratulations! You now own a small piece of a well-known corporation called a share of stock. You're a shareholder, sometimes also called a stockholder, since you're someone who owns a share of a company's stock. As a shareholder, you're now a key player in the world of corporate governance. But what is corporate governance? Corporate governance refers to the structure and method by which a company manages its decision-making process. The primary goal of corporate governance is to achieve an effective and efficient balance among corporate considerations, such as shareholder earnings and managerial decision-making power. A secondary goal of corporate governance is to provide a method for making decisions when there's conflict. Let's explore this in more detail. When the first U.S. corporations were created, the general rule was that one shareholder got to cast one vote. However, this rule was a problem because voting was disproportionate to ownership. In other words, shareholders with one share had the same decision-making power in the corporation as shareholders with many shares. Over time, the rule changed to one vote per share, allowing shareholders to vote proportionately to ownership. However, the new rule has some problems of its own. Now, shareholders with many shares are often very involved and vote regularly on corporate issues. However, shareholders like you with a small number of shares, in this case your AAPL stock, aren't very involved and vote rarely, if at all. For this reason, shareholders with many shares often make the most important decisions without any input from the other, smaller shareholders. These decisions are not always in the best interests of individual small shareholders like you or other key players. Additionally, these decisions may not be truly representative of ownership, because small shareholders, as a group, may own more than large shareholders, but may not have the same goals or interests. A corporation's decisions and actions affect many people and entities, known as stakeholders, who include shareholders, directors, employees, creditors, suppliers, and other interested parties. As noted, corporate governance involves the way a corporation's stakeholders interact with one another to make corporate decisions. However, not all stakeholders have an opportunity to participate in corporate governance. Within corporate governance, there are typically 3 key groups of stakeholders involved: shareholders, directors, and officers. In practice, these key players have the most power in corporate governance. 1. Shareholders. You already know that as an owner of an AAPL stock, you are a shareholder, and you can participate in corporate governance by voting on important issues. However, not all shareholders are people like you. Some shareholders are institutional investors, which are generally commercial or legal entities like mutual funds, insurance companies, trusts, investment banks, etc. They often invest in large quantities of stock in strong corporations on behalf of others. As noted previously, a shareholder with many shares often has more power than a shareholder with few shares. 2. Directors. Directors, often referred to as the board of directors, are often appointed or elected by the shareholders. These stakeholders are legally accountable for many actions of the corporation. The board of directors decides important issues and develops the long-term strategies of a corporation. 3. Officers. Officers are employees who serve the directors as top-level management, such as the CEO, CFO, and COO. These stakeholders often make the day-to-day decisions for the corporation. These decisions are intended to carry out the will of the shareholders and the directives of the board of directors. It isn't uncommon for officers to also be members of the board of directors. It's crucial to the corporation's health that the officers and board of directors work together. Due to conflicting interests, there's often disagreement between shareholders, directors, and officers. In the corporate boardroom, for example, directors often disagree, particularly if those directors serve other roles in the company, i.e., shareholders or officers. Directors are seeking to meet shareholder expectations while reducing their own risk, and sometimes prefer status quo over innovation. Officers, on the other hand, are often seeking sales growth, sometimes at the expense of shareholder earnings, or at risk to the directors, because features like sales growth often tie into an officer's earnings or bonus structure. Shareholders often only have one interest, stock price, and seek to protect it or increase it in any way they can. The powers of each key group to make decisions are generally limited by the corporate charter and corporate bylaws, which are the legal documents that created the corporation and set up its most basic structure. Decisions and actions of each key group may also be limited by the laws of the corporation's location, including city, state or province, and country. As an example of a bylaw's limitation, both shareholders and boards of directors have specific voting rules for making decisions, often included in the corporate bylaws, e.g., majority, 2/3 majority. However, voting rules are not the only limitations of power found in corporate documents. When a board of directors or the officer's power are limited in the charter or bylaws, it's usually regarding which rights and concerns can be considered when making certain decisions. There are many types of corporate bylaws, but we will discuss 2 extreme examples here. One corporation's bylaws may allow major decisions to be made only if they benefit shareholders. In other words, if a decision is best for the shareholders, but negatively affects other stakeholders or even the corporation itself, the corporation's directors and officers must choose and effectuate the option that's best for the shareholders. These governing bylaws can only be changed if shareholders vote to amend them. As an alternative example, a very different corporation's bylaws may require that the corporation act in a responsible way that serves the best interests of all stakeholders involved, perhaps even including the planet and population at large. In other words, before making a decision, everyone and/or everything affected must be considered. Although this corporation may consider the well-being of others in its decision process, the shareholders' interests still remain the highest priority. Okay, let's take a moment to review what we've learned. We first recapped that share of stock, which is basically just a small piece of a well-known corporation, and that a shareholder, aka a stockholder, is someone who owns a share of a company's stock. At its most basic level, we learned that corporate governance is the way key stakeholders interact with one another to make corporate decisions. We also learned that in corporate governance, the corporate charter and corporate bylaws set rules and limitations that limit the power of certain key stakeholders. Key stakeholders, including the shareholders, directors, and officers, must function within these corporate rules and limitations.
A financial accountant prepares financial statements and gathers information for use by people outside of the organization, such as investors, tax auditors, and shareholders. Managerial accounting information is developed specifically to provide managers with information they need to make business decisions within the company itself. Ethical violations can have far-reaching consequences for an organization. At the very least, they prevent managers from making sound business decisions. Larger ethical violations have caused entire organizations to shut down and people to go to jail for their participation. Ethical violations in managerial accounting commonly fall into 4 major categories. They include withholding information, misleading information, competence, and conflicts of interest. Let's begin by looking at our first example, withholding information. Not many people enjoy being the bearer of bad news. In some cases, it may be okay to keep negative information to yourself. However, financial professionals must disclose all information, both positive and negative. Managers rely on the advice and reports they receive from accountants. In some cases, there may be reasons for negative information that the managers already know about and are expecting. For example, if your division makes a major investment into a new company, there will be a lot of additional expenses during that reporting period. The equipment itself, lost time during the transition, training, etc. Other times there may be things going on that the manager does not know about, but needs to research in order to maintain an efficient and effective work environment. Now we'll look at how misleading information can violate managerial accounting ethics. If an accountant understands that it is unethical to withhold information, he or she may attempt to mislead others to make it appear that things are better or worse than what they really are. This may take the form of communicating the information in a way that makes it seem different than what it actually is. Another form of misleading information is when someone utilizes different methods to compute the data for reports. Accountants have specific rules that keep them from changing the method of computing data for reports because it can have a large impact on their profitability reports, including net profit. For example, when computing inventory value, there are at least 3 different methods to determine the value of inventory held by the company. One is called first in, first out, or just abbreviated as FIFO. The second is called last in, first out, or LIFO. Finally, there's weighted average valuation. If a report should be made in LFIO but the accountant changes it to FIFO, it can make net income appear larger because the value of the inventory increases and the lowest costs were allocated to goods that have already been sold. Now we'll look at issues of competence. Rules and laws in accounting are constantly changing, especially the Internal Revenue Service's tax laws. Financial professionals need to ensure that they are keeping current with all relevant updates to those laws as they apply to their organizations. Additionally, any reports that are generated should provide a professional analysis of the information so that managers can use them to make positive changes within the company. Competencies in accounting range from basic bookkeeping and communication to problem-solving and financial analysis. Skilled financial and managerial accountants will be able to recognize and deal with complex issues while being able to effectively communicate their findings to others in the organization. Here, we will address conflicts of interest. Conflicts of interest can come in many forms and levels. The most important thing to consider when it comes to conflicts of interest is the perception that a reasonable person would have regarded the situation. Let's say that you are a division manager at a company. If you found out that the accountant that provides you with information for your division took a large gift from an employee of a competing organization, what would you think? It may appear that you may need to question that person's loyalty to you and the organization. What if you found out that the gift was from her brother for her 20th wedding anniversary? Would that change your impression or doubts? The mere question about the reason why someone accepted a gift may be enough to cause the impression of a conflict of interest. In addition to gifts, other forms of conflicts of interest may arise in a number of different ways. These can include investments in competitors, actions that would cause others to question their loyalty to the organization, activities that discredit their accounting profession, seeking employment from another company, receiving compensation from other sources, relationships with persons in competing organizations, providing advice to multiple clients on the same issue, and finally, auditing your own work. Professional organizations such as the International Federation of Accountants and the American Institute of Certified Public Accountants have developed codes for ethics of conduct within their profession. Each organization holds its members accountable for their actions and attempts to ensure accountants remain at a very high standard of ethical behavior. If you have any information regarding unethical conduct of managerial or financial accountants, you are encouraged to contact one or more of these organizations along with your state's accountancy licensing board. Managerial accountants are expected to exhibit the highest levels of ethical behavior at all times. Corporate managers rely on the information provided by accountants to make the best decisions to positively impact the financial future of the company. Accountants who withhold information, provide misleading data, do not maintain a level of professional competence, or engage in conflicts of interest are not adhering to ethical standards. Organizations and state accountancy boards establish and enforce codes of ethics for those in the profession and can remove a professional license from anyone who does not display the ethical principles required. Businesses are constantly under pressure to make the best decisions possible. However, there is never a shortage of decisions to be made. From deciding whether or not to continue a product line to deciding how to treat a joint product, companies are constantly trying to make sure that they are maximizing profits while minimizing costs. This lesson will examine decisions regarding starting or stopping production on a good, outsourcing, using a constrained resource, and understanding how joint product costs can help companies make even more money. A crucial role of business is that a company can only be expected to offer a product line if it is profitable. Depending on the stage of the product, this could mean different things. For a product that is just being introduced, the money made from its sale should be enough to cover variable costs, fixed costs, and make a profit. Meanwhile, if a good has been sold for a while and is facing discontinuation, a company should keep it around only if its sales price is greater than variable costs. That means that it is still contributing money towards fixed costs and profits. Finally, special orders should be treated like new product lines. They should only be pursued if they are profitable. Another decision that is driven by a desire to save money is whether to outsource or allow another company to perform one of your business functions. Here, the analysis is pretty simple. Can you save money by having someone else do it all for you? Distribution is often outsourced. After all, many of us look for only a small number of companies to deliver our packages. Some companies have their own delivery trucks, and this is profitable for them to do so. However, for many companies, the costs of maintaining warehouses, distribution centers, and trucks is simply too much. Instead, they find it cheaper to outsource these tasks. Let's say that you run an ice cream truck. It's the middle of summer, and freezer space on board is limited. In this instance, space is a constrained resource, because it is limited in availability. Of course, your ice cream varieties have different variable costs, and take up different amounts of space in your truck. For example, a box of 12 ice cream sandwiches takes up half the room as a box of 12 ice cream tacos. Yet while you can make a profit of $1 per ice cream sandwich, you can make $2.50 per ice cream taco. These numbers are known as the contribution margins. By dividing the contribution margin by the area taken up by each box, 1 cubic foot for ice cream sandwiches and 2 cubic feet for ice cream tacos, we can see that each cubic foot of space is most profitable when it is used to sell ice cream tacos. For an ice cream truck driver aiming for profits, that means telling kids that you're all out of ice cream sandwiches. Finally, we get to joint product costs. Joint product costs are those products that share a great deal of the production process. For example, many electronic tablets are jointly produced. The point at which they are differentiated, for example, with different memory capacities, is called the split-off point. This is the point where we can finally find different profit values for each. As a rule, we should concentrate on whichever side produces the greater profit. For example, let's say that you sold a tablet with 16 gigabytes of memory for $500 and one with 128 gigabytes for $1,000. The 128 gigabyte hard drive adds $600 to your base cost of $200, while the 16 gigabyte drive is free. As a result, it is more profitable for you to sell the 16 gigabyte tablet. In this lesson, we looked at how to use cost determination to make the best business decisions. In short, businesses should always seek to maximize profits while minimizing costs. Minimizing costs can occur by outsourcing, which means to allow another company to perform one of your business functions, or through eliminating product lines that are not profitable. Meanwhile, maximizing profits can be done by making smart use of both joint products and constrained resources. Remember that a constrained resource is one that is only available in limited quantities. Also, it is the contribution margin, or difference of price and variable cost, which helps us determine just how to make the best use of those constrained resources. Finally, we have to be careful when analyzing products with joint product costs, when they share a great deal of the production process, in order to make sure that we keep the split-off point, or place where the products have different profit values, in mind.